what's up folks? This is Ferris with Trade with Tex, and for the first time ever, if you can't tell already, you get to put a face to the voice that you hear in these educational YouTube videos. Now, first things first, topic of discussion, we're going to talk about the 3 indicators that I think you need to be able to use in order to navigate these markets well, right? Day traders and swing traders alike, these indicators are universal, okay? Now, wanted to mention this is the norm from now on, right? Anytime I'm putting out an educational video, I'm going to walk you through it face to camera and have a more in-depth discussion so that you guys have a better resource for your trading, okay? If you're not subscribed to the channel, videos are only going to get better from here. So make sure you're subscribed and you can click the little bell that'll notify you anytime a video goes up. Also wanted to note, tradewithtex.com, link is in the description. That is our actual website with our chat room. If you don't have 50 bucks a month, you can join for free for a week. But let's get into it, right? I didn't put on a collared shirt and get all prettied up here for nothing. Let's talk about some of these techs. So first and foremost, the first indicator of the 3 that we're going to talk about here, Keltner channels. Also in our chat room, abbreviated as Kelts, right? Just easier to say. If you've used Bollinger Bands or the 20 SMA, right, then you've used kind of a weird variation of these, but the Keltner channels on this chart right now are just the yellow and blue lines. So let me remove everything but them so you guys can see this a little bit better. I left one thing on there, but this yellow line, this blue line, and this yellow line. Okay, we're in the Thinkorswim platform here, but they're pretty much universal, right? I mean, you can find them in any platform. And the way they work is we use them as a tool to read trend shifts, right? So this was super helpful for me in my trading because I always use Bollinger Bands, and I found out that I was a little bit too early to some of the moves and that would completely screw me up, or a little bit too late. And this helped big time with my execution because it helps you read trend shifts using these standard moving averages, right? The middle moving average here is the 20 EMA, right? Which means it's more responsive. That E stands for exponential. So it's a little bit more responsive than a simple moving average, okay? That's really the big factor that helped me with the whole too late, too early thing. And then the yellow lines here, I think by default they show up in white in Thinkorswim, but I changed them to yellow dotted lines. These are the upper and lower Kelts, and they're just +2, -2 standard deviations, okay? You don't need to know about all the math behind them. I do encourage you to learn it, but for the sake of this webinar, you don't really need to know that. You just need to know how to use them, okay? So I mainly use these for swing trading, but they are applicable to day trading as well. You just have to zoom in the time frame a little bit. So right now, we are on the daily, right? We're looking at the S&P so you can see just how universal these are because they work with everything. And basically the main way that I use them, I mainly like to play bounces off the lower Kelt, right? And I also like to play the 20 EMA cross up or down. So that middle blue line, you can see right here, whenever we cross above that with any type of significant strength, that's a very obvious buy signal. And you might be thinking, well, Ferris, if I'm buying here, where the hell do I sell? You sell at the upper Kelt, right? So it's not one of those strategies that's going to make you second guess yourself. It's very straightforward. You buy on the cross up, you sell at the upper Kelt. So here's an example. We can actually use any one of these as an example, but look at these dips on the S&P, right? These dips are pretty much designed to take your money, but as you can see, we bounced off the lower Kelt once, twice, 3 times now, right? All of these are setups for bounces, and then following those bounce setups, you can see that we crossed above, let me erase that, we crossed above right here, here, and here, indicating a move to the upper Kelt, okay? So as you can see, usually it should be within 1 to 2 candles, but the S&P can be a little bit slower sometimes if the volume's low, right? You can see volume was lower here, volume was not lower here, so it made the move faster, right? And then volume was somewhat lower here, not all that bad. It was a little bit higher, but it took 3 candles, okay? So basically the idea is that within 1 to 2 candles, we should be able to get to the upper Kelt. And if we zoom in, here's that blue line getting crossed above by price, right? And then 1, 2, 3, we hit the target. All right, so a little bit slower than usual, but it made it there. Fast forward again, and you can see cross up, 1, 2, 3, cross up, 1, 2, cross up, 1, 2. All right, made it to the upper Kel. And it's that simple, right? We're just using it for trend shifts. So this shows that the trend shifted up, right? Trend shifted up, and that keeps us on the right side of the trade as well. Okay? So Keltner channels, absolutely necessary. The main time frame that I use them on is the daily. I also encourage people using them on the 4-hour and 1-hour for consistent setups. Okay? Works really well with the S&P. All right? And again, these are just called the Keltner channels, so you can add them in any platform. If you go into your studies, this is what it looks like. Keltner channels, you can just type it in here. Keltner channels right there. Okay? And I just use the default settings. All right? Now, second one is the Stochastic Momentum Index. And real quick, before we get into that, if you haven't actually watched the video, I have arguably one of my favorite videos on the YouTube channel. It's called the Most Underrated Indicator. This is it, right? This is the most underrated one because not a lot of people use it. They use the slow stochastics, which are good, but why settle for good when you can be better, right? So stochastics are really good, again, for reading trend shifts, right? Very similar to Keltner channels. And if you can't tell, there's a reason these are in the same study set, right? You can see that right here with that trend shift, we knew we were on the right side of the trade because the Stochastic Momentum Index crossed up, right? The lower line crossed above the upper, and that indicated a buy. So on the S&P, these lined up with the buy signals that we saw before, right? Which was perfect clean-cut entry points for the long, okay, if you were to buy. Now, the way that you mainly use these are for standard trend continuations. However, there's one more way that's really effective, and this is why I was saying you might have some of these indicators, but you might not be using them the right way. Right? There are a bunch of times when we get a new guy in chat, he'll come in and go, oh, Ferris. That one didn't work out. That stochastic setup didn't work out. And the reason is, and this is the trick, if a stock is range bound, right? If a stock is range bound, so it's just going back and forth, it hasn't broken higher or lower for the day, okay? Easy way to spot this is the first 30 minutes of the day, right? If it's still within that first 30-minute range, then all you do is play the plus and minus 40 stochastic setups. So these lines right here, that's the plus 40 and the minus 40. That basically means you short when we get the signal of the cross down, that's above that line, right? You only buy when you get the cross up, that's below this line. That's when something is range bound. When you're playing a trend continuation, so it's broken out of its range, right? We have a range breakout, okay? You can play it just normally, right? You can play it without the plus and the 40 factored in. You can just play it with these buys that we were talking about earlier, okay? So again, if it's range bound, you're just playing it back and forth, waiting for the plus 40, minus 40 setups. If it's already broken out or down, then you can just use the stochastics normally, okay? So that's a little bit more advanced, but that's the gist of how they work. And again, really good for swing trading, very good for day trading as well, in the sense that day trading, you can use this on the 5-minute or the 1-minute, and it's perfect. Like even for gold today, I'll show you guys. Gold, of all things, you know, this is something that we trade pretty frequently in chat, but if you zoom it in, look at the signals here for gold. That means you buy here, here, and here, every single time, resulting in a pretty significant run-up. So whether you trade futures or options or common stock, there are a variety of ways to trade gold. Bottom line is this resulted in 3 big moves, didn't miss a single time, right? It did end up missing here, but at that point, the trend had shifted, right? You can see the moving averages crossing down, okay? So as long as your moving averages are intact, stochastic setup, you can pull the trigger, okay? And again, this is called the Stochastic Momentum Index. And a lot of different platforms will call it the SMI, but typically it's under stochastics in whatever platform you're using. Okay? And then the last indicator, this is actually arguably my favorite just because I've been using it the longest. This one hits home, right? I started trading with this. The Mac Daddy of indicators, the MACD, and I'll load up a study set with it in it, and I'll show you guys how I use it, which is a little bit different than the norm here. So let me pull up one of the tickers from today, Tesla, and I'll pull it up on the 15-minute. So notice how with the Kelts, I use a certain time frame. With the Stochastics, I use a certain time frame, right? And then with the MACD, typically I'm using either the 5-minute for something that's moving fast, right? The 15-minute if it's just a standard normal play, right, like Tesla, or, hear me out, the hourly for the larger time frame moves, and just to get an idea of what the hourly trend is. So the MACD stands for moving average convergence divergence. I'm sure a lot of you guys have researched this, or you at least use some variation. I just use the standard settings, right? I don't use the fib numbers. I don't do anything fancy. Standard settings work just fine for me. Basically, this is an oscillator that tells you when momentum is picking up or when momentum is dying down. So one of the big things that I do is I try to get the meat of the move when I'm trading, right? I don't really care about nailing the entire move. I just want the meat of the move so that I can walk away with a substantial profit, right? So the MACD helps me with that because basically the histogram, right, these bars in the background, whenever we see them start to increase or decrease, that signals moving averages coming together or pulling apart, right? When moving averages are pulling apart, so when the histogram is increasing, right, above the zero line, that means that we are seeing momentum pick up to the upside. When they are decreasing, momentum is decreasing, right? So this way you're only playing the higher momentum moves, which is ideal for a day trader, right? So for Tesla, this is a pretty good example today. Let's say you're trading the open, you play the buy signal at the opening bell, and you're using the 15-minute MACD to stay in the trade, right? As soon as we get that histogram bar decreasing, that tells us not that the stock is reversing and that it's done for the day, right? That's the common misconception. People go, oh, this thing's dead, time to short it. That's not true. This just tells us that momentum is dropping, right? Which means you jump ship and you can always get back in. That's the way you approach it, right? So Tesla, you jump ship, and moving forward, if these MACD histogram bars keep decreasing, you stay out, right? You don't get back in. If they start picking back up again, then you can jump back in, okay? And look at all that headache that you avoided here, right? Tesla pulled back, and I'm pretty sure that actually topped it out for the day. Yeah, had a bigger pullback after that, so it didn't make any other significant move, okay? So the main way I use it are just the histogram bars. When we get that opposite side of the move, I bail on the trade, right? If I'm taking it for a momentum trade. And then if we get them increasing again, I'll jump back in, okay? Same thing works on the other side, all right? So that being said, Keltner channels, that's number 1. Number 2, Stochastic Momentum Index. Number 3, MACD, okay? If you use them right and you use them on the right time frames, they are ruthless indicators. A lot of money to be made, okay? Now, that being said, if you guys have any questions about these, feel free to leave them in the comment section below. Again, if you haven't tried it out yet, join us in chat for a free week, right? We got a lot more experienced traders in there. It's not just me. But yeah, this is going to be the norm from now on. So hope you guys enjoyed the video. I'm looking forward to making more of these. And you all have a good one. All right, take it easy, folks.